So actually, when I was in college, for any of the students here, I didn't even know what commercial real estate was, so you're way ahead of me on that, and I have loved every minute of being in the industry. I have some colleagues here. I just celebrated my 10-year anniversary at Cushman. I am going to start by asking you guys a few questions, and if you could just indulge me. It's not a lot of effort or energy. I just want you to raise your hand when you feel a certain way about something, okay? Okay, yeah. So I wanted to ask you first how you're feeling about the year. And I'm going to start with the option of really, really good. I feel like this is going to be a great year. You guys are not the most optimistic bunch, which I don't know, I'm from DC and I come to Florida, I'm used to you guys being the most optimistic bunch. Okay, so few people say great. What about good, like decent? Okay. What about, we're gonna go kind of think good, decent, really bad, and there's something in the middle which is like, it's just okay. Just like okay. Okay. And how many people are kind of in the bad, like I think it's gonna be bad? Okay, so you guys aren't that pessimistic. Okay, there wasn't a single hand there. Oh, well, no, there was one. How many people just don't know? You're like, stop asking me questions. Yeah, there's a good number. How many of you know which president actually served as vice president for his arch nemesis? Andy's like, you didn't ask me this last night. No one? It was actually Jefferson. He served under John Adams. How many of you know, and you can't answer, Andy and Rick, which two presidents had pet alligators at the White House? You can shout it. We can use outdoor voices. It was not Roosevelt. So we had John Quincy Adams. What was going on with the founding fathers, you know what I mean? And Ben Harrison. So there you go. I know you're probably wondering, like, what does that have to do with the CRE outlook? And the answer is absolutely nothing, but you just learned something, and hopefully, at a minimum, you learned 2 new fun statistics. My goal is to give you a few new things beyond that in the next 40 minutes. I am going to start macro, and then we'll kind of dig into Florida, Orlando, give you some context for where the city falls respective to other key cities in Florida, but also really the nation as a whole. And I think, you know, the way I am starting today is to sort of level set, you know, and again, I'm coming from a different part of the country. I go all around the country. And when I show up in Florida, it's just things are gangbusters here. So I feel like I have to make sure you kind of understand what's happening everywhere else, and not just even in the US. As we head into 2024, we're going into a year where pretty much every region around the globe is seeing growth decelerate or downshift. And this is important because this creates choppy conditions, it creates more volatility, and we see years where things are opposite. So a great example would have been 2017, synchronized global growth, incredibly low volatility in financial markets. We're going into the opposite. Okay, so that's fact number 1 we need to kind of internalize. And we also have a lot of other just more esoteric risks that are not all market driven in nature. We do have high central bank rates around the globe with 2 exceptions pretty much, China being one of them. We have over half of the world's population going to polls to major elections, including in our own country. We have geopolitical uncertainty and tensions that are ratcheting up. They're not ratcheting down. Of course, we have the potential for energy price shocks. There's a lot of unknowns. Those tend to happen fast, as we saw in early 2022. And as all of you very much know, we're seeing more and more extreme weather, which actually does filter through into things like inflation here and there. So the point I'm trying to make is that these things are extra important to watch when the economy is downshifting and when things become more fragile, because these things can become triggers of other economic events. And so they're things that we need to watch. They're not things that you typically forecast in an econometric model. The next thing we need to level set on is inflation. Okay, so we got in a report this morning, we measured inflation two ways in the US. We like to make things more complicated compared to everyone else. And not only that, we also have core and super core and headline. I'm showing you both measures, CPI and PCE inflation, and I'm just showing you core and super core, okay? Because that's what the Fed is watching, that's how they're making decisions. And on a year-over-year basis, things look pretty good, right? Going down, we like that. It's headed down towards the target. A lot of disinflation that we've seen has been, in many ways, somewhat easy. And I say that because we've had base effects come out from the height of inflation. We've had disinflation in energy prices, most notably since the invasion of Ukraine. We've seen the impact of that invasion and other kind of one-off events, whether it's avian flu or climate issues in South America, feed through food inflation and dissipate. We've actually had goods disinflation and deflation, which has been important in the healing of supply chains and really a reflection of that. We've also imported some deflation from China. So we've gotten a lot of great things. But the problem is it's not that easy to continue to go down. And people say that, but really I want to give you some numbers to put to that, because when Powell said March is off the table, I was 100% not surprised. I was like, I absolutely was expecting that. I never would have expected a cut in March. Why? Because of what's happening here. Because since the middle of last year, near-term momentum in inflation in core and super core was re-accelerating. Okay, and there's no way that the Fed is going to look at that and say, you know, we got it in the bag, especially measures that are tied to the services-oriented industries that are most labor-dependent in the economy. So this is very much, I think, when the Fed says they're data-dependent, something to keep in mind. Those year-over-year measures don't always give us the best barometer of where inflation is headed in the near term. So this is just that 3-month growth rate annualized, so you can kind of see and compare that to the normal year-over-year measures. And again, it's going up across the board. We have more work to do, and I think this is creating a lot of uncertainty in the outlook for what the Fed is going to do this year. Don't worry, we'll talk about the Fed a lot, so we will come back to that. If there's one chart in my presentation that is the thing that kind of keeps me up at night, besides my 18-month-old son, it is this chart. And this chart is, I think, a great reflection of the slow burn that monetary policy has on the economy. In some ways, certain things filter through into credit conditions in real time, and we see it and we experience it in financial markets literally as it's happening, right? But we haven't been in a cycle for some time where we saw rates go up and then we just sat there for a while, right? We had the GFC, was down really, really fast, financial crisis, and throw everything we have at it. We get into COVID, we go to the zero lower bound, and we're throwing 13.3 facilities at this thing left and right. We're now in a world where we're at 5.5, 5.25, 5.5 Fed funds, and we're just sitting here. And frankly, the markets are changing their mind all the time on how long we could potentially sit here. This is showing you the interest burden in the bars relative to income across different sectors of the economy. The lighter blue bar is on average from 2015 to 2019, what that interest burden was. And the darker blue bar is where we are now with the latest data. That's third quarter data from last year. We get Q4 next week. So as you can imagine, on Tuesday morning when that comes out, that's what I'll be doing. I expect it to look similar, but for all those dark blue bars to go up a little bit. So what we know is in most industries, the interest burden relative to incomes is now more onerous than it was before the pandemic. And the gray dot is showing us the rate at which that interest expense is growing. And I'm not making this up. If you look at this, since liftoff, since basically 2 years ago, interest burdens in the information sector on the low end have risen by 35%, and the interest burden of the professional and technical services sector on the high end has risen by 78%. And that's still going up because we're not the only industry with a maturity wall. There are debt maturities happening in non-financial corporates, financial corporates, leverage loans. The economy is slowly repricing, and what that results in, and I hear this all the time in anecdotes with clients in the field, I'm being very strategic and discerning about my capital investment. This is really expensive to deploy money right now. I'm gonna lay people off, or I'm gonna let attrition happen, and I'm only gonna make strategic hires. And it's that kind of environment that is dominating the way that companies are approaching this year, and it's creating some caution in how they make real estate decisions. Now, this is all to set up a backdrop of let's level set. Let's just be honest about the things that are happening in the economy, the challenges that it does face from very macro factors. And then you juxtapose that with we just actually had a pretty good year, right? And everybody thought there was going to be a recession, and then it didn't happen, and what's going on? I'm just giving you a bunch of labor market and other positive indicators from last year. Equities performing, wage growth, real wage growth turned positive last year. We've got a manufacturing renaissance within certain parts of manufacturing. Why did people get last year wrong? I think there are a few factors, but let me tell you one that really bothered me, which was the following. Okay, imagine it's December of 2022, and you think, hey, consumers only have this much amount of excess savings, and probably by the middle of 2023, that's gonna be gone, and the second half of the year is gonna be a little bit tough for consumers, especially with rates being where they are. Okay, so you say, yeah, we might have a moderate recession towards the end of 2023. The consumer savings are really gonna be depleted by then. And then 23 is unfolding, and you're like, man, things look pretty good, and things are coming in pretty decently. And then October of 2023 rolls around, and you get a revision from the Bureau of Economic Analysis that says, oh, by the way, there's $500 billion extra dollars in consumers' wallets that we didn't tell you about as of last year. So you kind of didn't know something really important about the health of consumer balance sheets. And that really is a story of what happened last year. So we're basically back where we were in December of 2022, all over again, coming into 2024. Consumers have now burnt through the revised excess savings that we now know that they had, and we're entering into a choppier environment for the consumer sector, and I focus on that because they are 2/3 of our GDP. Now there are, despite the resilience in consumers and the fact the labor market has held up, there are cracks in the macro economy, and I just want to be clear about that. There are recessions happening in certain sectors, right? Manufacturing is one of them. We have a renaissance happening in a subset of manufacturing that is 1.2% of manufacturing output in this country. Most manufacturing is seeing very, very soft conditions, right? Freight and transportation, anything in that sector outside of aviation, we're seeing contractions, right? We're seeing actually in some cases very deep contractions. We have cracks starting to form in the labor market. Last year we were losing jobs in warehousing and most subsets of transportation. We were losing jobs in credit intermediation and in other pockets of office using employment, such that at the national level, 9 of the last 10 months, we've lost office using jobs on net across the country. So there are these cracks that are forming, and I think that this just speaks to, again, some of the fragility that's out there. This is no longer 2021, 2022, when every single sector is growing and growing very rapidly. And in case you didn't know, we're one of those interest rate sensitive sectors that is in our own recession. You can think of it as a broad recession, a volumes recession. It's happening across leasing and capital markets. It's happening across all sectors too, not just office. So the outlook is highly uncertain. There are factors at play in determining what happens that are subject to change as the year goes on, right? The Fed being probably first and foremost, how certain geopolitical things play out, how the government situation works out this weekend. Do they drop the ball again? Do we go into sequestration, which is an April 1st deadline? And the reality is, even if we get a soft landing, which has been kind of where the consensus has gone recently, there's only a limit to how much GDP is going to grow, right? So the upside risk is limited in terms of how much actual growth you get, given the other constraints in the economy. There's a decent chance that we get a fairly anemic soft landing, that it ends up that monetary policy continues to squeeze us because we're still tightening, because we still have QT, real rates are still going up as inflation goes down, right? So we're still feeling the squeeze of that. So there's a real chance that as the year progresses, growth does start to deteriorate more. And of course, you can create many kind of downside scenarios where you can even think, wow, there are possibilities, they're tail end risks, but there are possibilities of other things happening. I think the exciting thing is, even in a world where, let's say you get a probable outcome here, a soft landing, or even something like basically no growth, or even a moderate recession, there are a lot of opportunities that still actually are out there, whether it's in different industries. So on the left-hand side, I'm showing you 800 industries at a very detailed level, and the share of them that are growing in any given year. And outside of pretty much the GFC, you see that in most years, including recessionary years, there are many sectors that are growing. And there have been recessions where we still see more than half of industries growing. And the same thing is also true of cities, right? So when we look at what has happened in cities, it was really the double dip of the 80s, the GFC, and COVID, where we saw a lot of cities contract simultaneously. But otherwise, we've seen growth. And in fact, in Florida, you know, if you look at North Florida and Orlando specifically, you've only contracted in 2 recessions on a GDP basis going back to 1980. And that was in the GFC, which shouldn't be a surprise to anybody who has any awareness of the housing crisis, and during COVID, when we were all locked down and it was not a market-driven sort of recession in some ways. So I think there's some resilience here. And so, you know, we're in a view at Cushman where we do think that the economy is going to downshift this year. We essentially think in the second half of the year, GDP is going to flatline, right? We're going to see investment eroding, trade kind of a drag on GDP. We think consumer growth is going to remain, but it's going to decelerate. But we still think that actually Orlando and South Florida are going to continue to grow at around 3% this year and next year. And that speaks to some structural tailwinds that exist here in this market and frankly across the state. And I think it illustrates why sometimes macro numbers matter and then sometimes they're not as relevant. And I'm going to give you more examples of that as we go. So I like to kind of get a sense of where I'm going, because I live in DC, I'm in the New England corridor a lot. And so whenever I travel, I'm like, what's going on in this state? And the really great real-time barometer of the labor market's strength and the resilience is what's going on in initial claims. It's a weekly data point. It's about as real-time as the government can get. And you guys are really one of the only states where current claims across pretty much every industry are not only below their 2019 levels, they're also below the levels that were observed when the Fed lifted off in this rate hiking cycle. I can tell you, I've been in other Sunbelt states that are high growth with all the migration, and the chart doesn't look like this. It's much more of a mixed bag. The cracks are forming. Not so much in Florida. So for any of you who didn't raise your hand, like things are great, here's a slide where you can get a little excited. Things are looking pretty good in the labor market in terms of the resilience that we see there. Here's just a pulse check on Orlando specifically in the labor market. Outperformed on pretty much every measure, so good job. Our northern cities, it's a little bit of a more difficult chart to look at when we do this. But you guys, total non-farm jobs are 7.5% above the pre-pandemic level. Almost all sectors are fully recovered with the exception of state and local government. State government is actually a small share. Local government tends to be a bigger employer, and that's public school teachers for the most part that we have not fully gotten back to work. Services, which are just small format retail, nail salons, hardware shops, and so on. So the lagging sectors here are lagging in every city around the country. Your labor force is 17% larger. That is a wild number, by the way. But still, right? As the Fed has tightened policy, as they have said, we want to reduce the pressure on the labor market, right, through our policy. An objective is to loosen the imbalance between labor supply and demand. We've seen job growth decelerate everywhere, including in Orlando and including across the state of Florida. This is just giving you a sense of what that trend line looks like. And again, we're entering into a year where we're probably going to see some sectors lose some jobs, some gain, and it's going to vary on a month-to-month basis, and it's going to be choppier than what we've experienced the last few years. So we're here for commercial real estate. So let's talk about some commercial real estate. I'm going to start with multifamily because, you know, the thing that's fueling your labor force is this in-migration, this tremendous in-migration. It did peak in 2021. It was still very strong in 2022. In 2023, migration into the Sun Belt, including Florida, basically not only went back to pre-COVID trends, but it actually was lower than pre-COVID trends. So we've seen a really strong tempering in the pace of migration. However, there are still dividends to the tremendous population growth that has happened, but we're in a period where there's some imbalance between supply and demand. Okay, and that's just reflected here in the chart. Supply, demand, we've seen vacancy now creep up to 11% on an overall basis. This is a pretty high rate for the market. Stabilized is closer to 7, but that speaks to the level of construction given the differential between them. And we're in a world, though, where I think for multifamily, what is really important is there is a stark imbalance between supply and demand in the near term. But notice that there is still pretty strong demand, right? This is not a situation where demand has collapsed. And moving forward, we're expecting on average over the next 3 years that we continue to see 5,000 to 6,000 units absorbed per year. Now you have 20,000 units underway, and that's about 10% of your inventory. And I'm just highlighting in green is Orlando, dark blue are other Florida markets, light blue is everything else. Florida's building, it has a lot of people coming here, that makes sense. And you might look at this and say, oh my gosh, given that we have 11% vacancy and we have this tremendous pipeline, especially relative to the country, this is getting a little risky. Well, there's demand, so we can't not count demand. And again, we're probably in a normalizing period where we get 5,000 to 6,000 units on average per year in absorption. So if I said, how many years does it take to absorb 20,000 units? We could probably all do the math and figure out that's 3 to 4 years. And then you could say, well, how many years would it just take to get from 11 back down to pre-pandemic vacancy? And that's the dot. That's just saying, you know, in Orlando, it's looking like a 5-year process. That's not a 5-year process to peak vacancy. That's a 5-year process to 2019 Q4 vacancy, which is actually a fairly short period of time. And the reality is, I'll come back to this a lot, the number one predictor of rent growth is vacancy. So we are seeing rent soften, right? We're seeing it even decline in 3 of the Florida markets that we track, including Orlando, on a year-over-year basis. But that is something that will start to bottom out as we see vacancy peak. And we think that we're going to be in that situation in the second half of next year. And so even before vacancy returns to a much tighter level, we will start to see rent appreciation again. And I'm going to come back to some references to this as we talk about other sectors that also have supply waves, but some of the underlying details start to become a bit different. I think something important for a state like Florida or a city like Orlando, where there is a high dependence on tourism, it is important to kind of understand what's happening globally, because there are some important undertones. Despite headline GDP growth in almost all regions just going down this year, there are important things that consumers are doing. Okay, and one of those is rotating back into services, and in the US in particular, there's pent-up demand for services. And we know that that's going to continue to come to the market even as headline growth slows. This is also happening across other advanced economies, so much so to the tune that we think this year we will, for the first time since COVID, surpass 2019 levels of tourist arrivals in the US. And so this is really just a tailwind to any tourist-dependent market or state like the state of Florida. Now, I mentioned the in-migration to Orlando and to Florida more generally in my remarks about multifamily, because I think there's a very clear line of logic as to how those things are connected. This is showing you, I know it's a lot of dots, don't worry, we'll let you have the slides and you can look at the dots when you get it. But on the x-axis, this is population growth. On the y-axis is retail demand. And the circle has pretty much every Florida market. You guys are where it's at with respect to retail demand. And it really is correlated to population growth, and when there's population growth, we tend to see benefits for the labor market, and we also tend to see those households buy things in the local economy, and we still spend 80% of our dollars at brick and mortar retail. I'll just point out for any of you who care, you guys are ahead of Texas. Texas is not in the circle, so for anybody who does a comparison between those, you guys are only next to Vegas and other Nevada cities. So what's going on with retail? Well, retail is performing very, very well. And I'm gonna give you one reason why I think sometimes it still doesn't get fully recognized for that performance. On this chart, I'm just giving you a sense of how retail sales have performed in the US versus key Florida cities. Now, these are nominal, but even when you adjust for appropriate measures of inflation at the city level, you still see that in Orlando has had real retail sales grow over 20% in contrast to the US of closer to about 12% when you look at comparable cities. The vacancy rate for retail nationally is sitting at 5.3%. That's the lowest in 40 years in our data. And you can see the Orlando vacancy rate over that, which is about 100 basis points lower. And out of all of the major markets in Florida that we track, there's only one that has a vacancy rate that is slightly higher by 50 basis points than the US number of 5.3, and that city is Jacksonville. Every other market in Florida is about 100 basis points tighter than the nation, Miami even more so. And it begs the question, why does retail kind of get a bad rep, right? What's going on with that? Well, most retail is not malls, but malls create some problems for things like CMBS delinquency rates, and therefore it gets a sort of outsized influence on how outsiders especially think about the sector. 1% of buildings in the country that are retail assets are actually malls. 1% of retail buildings are malls, 8% of retail inventory is malls, 24% of delinquent loans by loan count are malls. 40% of delinquent loan balances within the retail sector are within malls. So they make up an outsized share of distress, especially in a legacy retail kind of way. And you think about the challenges retail has gone through for decades. This is something we're very excited about. There are a lot of opportunities in retail, and as you think about retail more broadly, you see that there are actual really, really strong signs of strength. And this is just giving you a sense of how rent growth has performed, again, with Orlando in green, having grown about 30% in rents since the beginning of the pandemic, other Florida markets even surpassing that, all Florida markets surpassing the national average of about 17%. So very strong backdrop there, and probably not gonna change all that much. A little supply risk, there's basically none, right? There's very little construction. We have resilient consumers pushing back into services. So there's not as much demand risk as we might think, given some of the patterns that we're seeing happen within consumers. The challenge for retail occupiers is, one, navigating a really tight retail market and high rents. I talk to a lot of retail occupiers who feel like they have no options, right? And they have to get in and renegotiate very far in advance because they know that things need to change in terms of how they're planning for cost increases. And this is kind of a double whammy for them when they also think about the fact that they have an online presence and the fact that they have warehouse space. Any occupier, whether they're a retailer, a wholesaler, manufacturer, anybody who has industrial space has gone through a fundamental repricing that has been magnificent over the course of the pandemic. Here I am showing you national absorption in dark blue. The very light gray line is Florida's absorption, and the green line is Orlando's absorption. And you see, both in Florida and nationally, we got these two crazy years. And as we headed into 2023, we said, look, consumers are pulling back from good spending. The housing market is going through a tough time. 10% of inventories are basically in adjacent housing categories like home goods, home improvements, furniture, and so on. I'm even excluding construction from that number. And we also knew that some of the influence from e-commerce was pulled forward during COVID, and that's at the expense of the future. So we knew demand would soften. It did soften, right on par with our projections, and we think that that's going to continue to weigh on the market this year. Now, this is like a first world problem in the sense we still have positive demand. We're expecting a little under 200 million square feet of absorption nationally. I can tell you, anybody in office in here, we would just a third of that, a half of that. I mean, any kind of that we would take. In Florida, we're still expecting a lot of resilience, right? You're looking at absorption that is on par with kind of where we were in 2015 to 2019. The issue, much like with multifamily here, is we have a supply wave coming, right? We have a lot of construction, obviously not so much in Miami where we're land constrained, but in other markets, we've had a supply boom. And so that might create a dynamic similar to multifamily. Actually, there are some important differences. The imbalance between supply and demand in industrial is less significant than it is for multifamily. So the upward pressure on vacancy is less pronounced, okay? And again, the number one predictor of rent growth is vacancy. So when you see that, while we expect multifamily rents to soften, and they are in markets where vacancy is rising the fastest, we actually don't expect industrial rents to decline at all. We think growth will be a little bit lower, but we still expect rents to go up. And we're still gonna be at fairly historic tight levels of vacancy in most markets. And that's what I'm showing you here on the left, just a variety of our Florida markets as an example of that, but you can pick any market around the country with few exceptions and it would look like that. On the right-hand side, what I'm showing you is a rent index where 2015 is equal to 100. And what this is showing you is that in a market like Orlando, which has tracked the broader South region, the census region, your rents are up about 75% over that time frame. Now that's a lot, but you're a little bit below the US, okay? The Midwest and the South have kind of lagged, and more land constrained markets along the West Coast and the Northeast, they have been kind of on the higher end, and they look a bit more like your Miami, which is that red line on top, okay? And in that market, rents are up 175%. When I say there has been a fundamental repricing, I really mean it. And the difference that this creates, the reason why we're most optimistic in the next 2 years about NOI growth and returns for industrial is because the weighted average lease term for industrial is still 6 to 7 years. So the repricing that took place is still filtering through into the market and into NOI returns as we move forward. And that's a very different kind of backdrop than even when we look at an asset class like multifamily. So I will come back to that yet again in remarks I make here in a few moments, but something to keep in mind. So we got to office. For anybody who was waiting for the moment, office is challenged. Right? That's not a secret. We've had record-setting negative demand in this country since the onset of the pandemic. Typically in recessions, we lose about 100 million square feet in negative demand during .com, during the GFC. That's typically about a 2.5% drawdown in the level of occupied inventory. Since COVID, it's been about 250 million square feet of negative demand, so times 2.5. Right? It's been about a 4.5% drawdown in the level of occupied inventory. What I'm showing you here is, again, a lot of dots. Some of my colleagues know I like a good scatter plot because they show a lot of information in a succinct way. On the x-axis, I'm showing you the change in the vacancy rate since the pandemic, and on the vertical axis, I'm showing you the current vacancy rate. And I've kind of highlighted where we have different Florida markets. But I think the reality is every city has its own story, right? So when I think about where has the biggest issue been demand, where has demand been the reason vacancy went up so much? Well, San Francisco, look at San Francisco, but that's all demand, that's not supply. You have Phoenix. Phoenix is in the bottom 10 in the country for office demand. And they've actually had very limited construction since the beginning of the pandemic. But it's Phoenix, Sun Belt, high growth, in-migration, doesn't matter. Then you think, well, where has it been? Maybe both, supply and demand. You might not know this, New York City. New York City has had an average demand impact despite the press that it gets, but it has a lot of supply, so the vacancy rate has gone up a lot. Austin, Texas. It has below average demand for its size. It's been hit harder than the nation as a whole from a negative demand perspective, but it has a tremendous amount of supply. Where is it really more supply driven? Nashville, Salt Lake City, Charlotte, Raleigh, Durham. Out of the Florida markets, I would say Orlando is falling more into the demand-led driven increase in vacancy. Okay, so it's been a little bit less because of supply. There's more constrained development here, but it is even more nuanced than this, okay? We can look at segmentation of the market. We can say, well, what's going on in different asset classes? Here I am showing you Florida, so major markets in Florida, just add them up, put them together. And on the left, we have Class B and C vacancy in light blue. We have Class A in the slightly darker shade. And then we have what we call newer Class A. This is newly developed product since 2016. And we include and exclude in those two lines buildings that are in lease up for obvious reasons because they can have an outsized share impact on vacancy rates. What you can see on the right is really that all the demand has been in newer product since the beginning of the pandemic. That's true nationally, it's true in Florida. There is a flight to quality that is happening. I just have to prove it with some data, but I think we all recognize that this has been a trend that is ongoing. Here's something though that goes even further, okay, and this is where I get to nerd out a little bit with the building level data. So I just pulled out, we have 414 buildings in our competitive set for the office sector for Orlando, and what I'm showing you may surprise you. 50% of office buildings in Orlando are fully leased. Yeah, I don't know any reporter that wrote about that. 10% are 90% leased or better. So we have 60% of office buildings that are 90 to 100% leased. And in fact, 95% of buildings in the city of Orlando have no sublease space. Those are important things. We actually only have 24 buildings that have a very high vacancy rate of 50% or more. Those 24 buildings are 6.7% of the stock. Their vacancy rate, when you add those up together, is 74%. So, okay, let's do some math here. We have 24 buildings with 74% vacancy. We have a whole market with a 15.5% vacancy. If we take out the 24 buildings, we have 390 left with a vacancy rate of 11%, not 15.5%. So when we think about the office market, and we deal with this with occupiers, owners, lenders all the time, it is very nuanced. We cannot, at this point, paint with a broad brush. I'm not trying to understate the challenge that office has, but it is to, I think, acknowledge and recognize the complexity of what is happening in that headline statistics can be, in fact, not that useful once you start to dig into the data this way. Now, it typically is a very natural segue when you talk about office to then start to talk about price declines and distress. So we are going to just acknowledge that interest rates are higher for everyone, for CRE, for all other sectors, and the reality is that cap rates have to go up. And because there aren't a lot of transactions, we're not seeing buyers and sellers consummate and record actual transactions in private markets, and so we don't have a lot of price discovery. But as time passes, and certainly as transaction velocity picks up, which we think will happen after the Fed pivots, especially in the second half of this year, we should see more of that repricing start to happen. And if we as an asset class remain attractive on a risk-adjusted basis relative to other asset types, that means cap rates go up, and they go up for everyone, every market, every asset type. Different levels, right, depending upon the quality or the sector or the market, but they go up. And this increase implies about a 40% decline in values. That's a big number, and I recognize that that is like a lot of sticker shock. So let me just say, I don't know how many investors in this room have had the uniquely amazing precision to buy every asset in your portfolio at the peak and to sell precisely at the trough. I hope none of you have that amount of skill, but if you did, then that would be your return, right? But that's not the return any investor should expect. It is a number, right, that does reflect a peak to trough decline, but it does not reflect, in our view, the return of any individual investor given the staggered nature of acquiring, disposition, and so on and so forth. Just like to make that clear because of the sticker shock. Okay, so one impetus to price discovery, especially before we see more unlocking in the capital markets, is going to be through maturities. By the way, we're not the only sector with a loan maturity wall, but here it is, both the US maturity wall as well as key markets in Florida. Two things stand out to me about Florida. One is you're a little bit more loaded this year relative to 2025 compared to the US. And two is you're a bit more exposed to multi, no surprise, as well as retail and hotel versus the broader US. The flip side of that is not a lot of office. So maybe some good news there. But it won't just be office, right? So one area that we're keenly focused on for areas of distress where, distress is a loss for one investor, it's an opportunity for another. So it's two sides of the same coin. We have a lot of deals that took place in 21 and 22, very, very busy years for multifamily. As you can see, 40% of debt that was originated during 21 and 22 was floating rate. Of that, 60% was short term, so kind of 5 years or less. This is going to be where the most problems happen, and we can kind of go in and figure out exactly where those are and monitor them to say, hey, this is looking increasing like it might have some kind of event. But the reality for multifamily is actually there's just a lot of capital that wants it. So even when you talk to even banks, right, we'll take your distressed multifamily because we know we're going to be able to sell that into the marketplace, right? There's dry powder everywhere, and it's most interested in distressed multifamily and whatever distressed industrial happens to come through, although it's probably not going to be a lot. The reality is that we still face this fundamental issue around office in the nation, around obsolescence and the mounting distress. As you can see, it is the largest category. It's just not really where the dry powder wants to go. So when we really think about risks to investors, risks to lenders, to the financial system, this is really where it comes back to. It really does look, based on the data and the capital that's out there, that other pockets of distress will be temporary because, of course, in any time of dislocation like this, if you have capital and courage, as Peter Linneman says, you make a really, really great forward return as we head into the next cycle. And that's exactly what we think will happen. The last kind of subtopic I wanted to hit on, I think, is one that is clearly top of mind for the state of Florida, and that is around the rising challenge of insurance costs. So I'm just giving you a sense nationally of how insurance costs have risen. This is just the share of operating expenses that are basically going to insurance for each major sector. And you can see it's risen substantially throughout the course of the pandemic. And I'm just giving you a sense of multifamily insurance costs for Orlando specifically here. Now, I don't have an answer for insurance. This is the beginning of markets starting to price in a more substantial and transparent way what the costs are associated with growing climate risks. Right? And this is happening especially on coasts, but it's very clearly happening in markets that are more exposed to different kinds of climate events. And the reason that I say it's just, in my view, in the beginning, and so it's a known unknown, there's a lot we don't know, is because the federal government is still trying to figure out how to price this risk. And when they start to price this into their regulatory frameworks, when the GSEs start to price this in the way they think about the risks they're taking, it filters through to the whole market. So there's a lot we don't know. This is definitely something that I know is top of mind in DC. I'm going to a conference next month on this topic. I'm getting called from people in Congress and regulators to ask about these things because they want to start to price it more efficiently. So the one thing I do know is this is not going away. This is going to remain a topic that we have to stay laser focused on. And in the interim, it does challenge us because operational alpha, the income side of our return, is really what's going to drive things for the next 18 months. And I say that because we're probably not going back to the zero lower bound, right? And I hope nobody wants us to go back because that's a pretty dark scenario. In a world where we don't, and every consensus forecast shows us hanging out in 3.5% to 4% 10-year treasury land, well, that means we don't get the kinds of cap rate compression that we did historically. Historically, 10-year returns have averaged what's here on the left. And what you can see is CRE has outperformed all asset types on a rolling 10-year forward basis going back 40 years. CRE has been attractive. The height of the bar is higher across the board than it is over the next 10 years because of the lack of interest rates going back down, the lack of the equivalent of cap rate compression and returns moving forward. But the fact that CRE is still higher makes us very excited. It means that on a risk-adjusted basis, CRE is very attractive. There are lots of opportunities. Right? The world needs commercial real estate. The way it needs it, the kinds it needs, change over time. That's been true for decades in the past. It's going to remain true over the next decade, and that makes us really excited. And it should make everybody excited in here that there are opportunities. We are in a cyclical moment, but there are these structural tailwinds that are going to lead to better days ahead for commercial real estate. Thank you.